I'm Vern Hoven, a CPA with a master's in tax, and I'm hosting today a discussion on post-election tax roundtable. And I am joined, just absolutely joyfully joined, by two real special guests. And first one is going to end up being Karen Brosi.
Well, I'm Karen Brosi, and my practice is in Palo Alto, California, right in the heart of the Silicon Valley.
And I'm Sharon Kreider, and I also am in California in the heart of Silicon Valley. I have a practice in Sunnyvale, California, but I also am in Bozeman, Montana a lot.
Hey, I want to stay with you. You're the one that we have, you are the go-to person in dealing with real estate. And so any changes in the area of real estate that you would expect would be supported by President-elect Biden?
Yes, the President-elect Biden's proposal, although I'm going to have to deal this one out with a bit of a disclaimer. From what I read, the proposal would make changes to the like-kind exchange rules under Code Section 1031, or further changes since we had changes out of the Tax Cuts and Jobs Act most recently. But the proposal is not really detailed, but from what I understand, it would either or both limit the amount of deferred exchange to a cap of around $1 million. Any additional realized gain would have to be recognized. And or it could place that same kind of $1 million limit on the entire exchange if income for the taxpayer was over $1 million. And so that's the way I read that proposal right now. Interestingly enough, tax deferred exchanges, we were rather startled with the Tax Cuts and Jobs Act change because Code Section 1031 has long been kind of a sacred cow in the tax code of allowing taxpayers to continue to invest rather than pull their money out of equipment, machinery, real estate in this particular case. And so I think that this is probably also a harder reach for, or a harder ask for bipartisan support in this particular area. And it comes at the same time of a proposed higher capital gains rate. So it's kind of a double punch, if you will, that if there is a limit on the amount you can exchange tax deferred and any remaining realized gain would be taxable, and we know that that's already in the over $1 million range, and then you're going to take and move the top capital gains rate up to ordinary income rate of 39.6. It really focuses a burden under the tax law on wealthier investors and individuals.
So let me just change another topic. And I do know that this is one that you deal a lot with. So do you, with your client base. Any changes in the area of estate and trusts?
Oh,
Gifts.
major proposals.
What are you
Major
talking
proposals to reduce the exemption amount down to 2009 levels. Now, I had heard when TCJA doubled the exemption, it's about $11,580,000 or something like that right now.
That's what it is
per
for sure.
individual. So this $11 million, they doubled our inflation adjusted $5 million, and now it sits at $11,580. That I'd heard it would drop back to that inflation adjusted $5 million. No, this would take it back to $3.5 million. That is a big change. But if I were a negotiator, as we believe Mr. Biden is, I might start at 3.5 and settle at inflation adjusted 5 would be at about $6 million, somewhere in that area. But right now his proposal is $3.5 million and another change that would affect those people exchanging as well as our other estate tax people paying estate taxes, is step up in basis would be gone. Now, we've tried that. I think, at least 3 other times, and it's been pulled back each time.
But you know what's startling about that to me is in my past memory, I have only heard elimination of step up in basis associated with high exemption or elimination of the estate tax.
Yes.
So those two things seem to go together in my brain. No estate tax, no step up in basis, because we're not in any way taxing these assets upon someone's death. So somewhere along the line we want to get some tax. But now this proposal would lower the estate exclusion amount, making more individual estates subject to estate tax. But those same assets subject to estate tax would not receive a step up in basis. Isn't that a double tax?
Oh, good thinking. We're real short of money. Well, I hope this is a starting point on a negotiation, not really what would be, even if there were a friendly Senate. But we have tried before on the elimination of the step up in basis too. Great complications and complexities and arguments about it. But because you talked about tax deferred exchanges, right? So we have exchange, die, then we have a step up, and we've been able to pass on for our wealthy people to our beneficiaries high basis property. Now, I suspect your complaint about, wait a minute, if we lower the exemption and there's 40% on the fair market value, but we're going to eliminate step up in basis, based upon what? Based upon something connected with the estate tax too. We could work that out if we were given enough time we could make it more complicated.
Well, yes, we could. And that's a great place to insert, however, that the president-elect, in making his proposals public, said that his key emphasis was on simplification and fairness.
Yes.
And this one kind of item that we've touched on alone is neither simple nor, if it does result in a double taxation that doesn't exist currently, does it seem to be fair.
Well, I believe that every presidential candidate has asked for simplification and fairness, and then the result is never quite what we expect.
Exactly.
Okay, so we've just done a hammer job on some of the proposals we're seeing in the area of individual. Now let's go to the area of business. And we'll start with you on it. Of course, you know that I am going to start out with the question, QBI.
QBI.
They're gonna repeal that puppy?
Well, no, not repeal it, just modify it so it doesn't work for very many people. Now, who it would work for is those people with less than $400,000 of income.
Right.
As President-elect Biden has said, this is meant to hit people above $400,000. So this would be a takeaway for those people, no QBI. It might simplify the tax return if they sort of fed that into the specified service, trade, or business and the other parts that went into our limitations, W-2 wages, for example. If they just said, hey, your income's under $400,000, you get 20% against your net, your qualified business income, we might breathe a sigh of relief on all the many other things that have shown up on the QBI. Not that that would please our investor clients and our business owners, but that's his proposal on QBI. He also has a proposal which I believe will eventually have some bipartisan support, and that is increasing the corporate tax rate from 21%. It went from 25 down to 21, and he has proposed raising it to 28%. I read one of the big four accounting firms surveyed the CFOs in their purview, and that would be a lot of Fortune 500s and very big companies, right? And 70% of those CFOs expect the corporate rate to go up, and they are already making plans about an increased tax rate. So I don't know that it goes as high as 28, but we do have a substantial increase in our deficit because of COVID-19 relief, the pandemic relief. at least $3 trillion is what we've seen so far, and it may even be more as more budget numbers or performance numbers come in. So I think there'll be some bipartisan support from those budget deficit hawks in the
Yes.
Senate. It just might not be 21 to 28, but that's in between the 35 and the 21,
Yes.
coincidentally.
Well, and as we were talking earlier, Vern, you had an interesting question when we were talking about change from 21 to 28% corporate tax rate. And I don't know if you remember, but your interesting question was still flat tax. And because that could also be part of the negotiation, I think, is that no, we'll retain the 21% rate under TCJA, but at some income, taxable income level, it would kick in to 28%.
And I could even tell you a taxable income level that is proposed for something else. It's $100 million, so it's aimed at the really big companies. And that's a minimum tax on corporations, and they would pay a minimum tax as their income went up above $100 million. Book profit
Yes.
went up above $100 million. So that might be part of what happens. Also doubling the GILTI tax. The global intangible low tax income is at 10.5%, raising that to 21%. So there are other proposals that would increase the corporate tax, because we do know that there's a lot of media coverage and our own tax journal coverage on the large corporations not paying tax or not paying their fair share of tax.
Yeah.
And so these proposals might be part of that also.
Well, but in there, then, let's focus for a second on raising the tax on raising the tax both on non-corporate businesses on pass-throughs if you limit QBI, and raising the corporate tax rate. Does not that run sort of counterintuitive to encouraging business growth in this country? Are there some proposals in there that would help in that regard?
Well, it runs counterintuitive to that, and also to that we're reducing the taxes on lower income people, because these large companies and these businesses pay wages
to lower income individuals.
Right. So if they're unable to help on that, I mean, there are a few,
But I did notice some credits.
some refundable
I guess is where I'm
energy.
going.
Because Vice President, President-elect Biden has talked about the green something or other, he has proposals on many more energy credits than we had before, perhaps to offset what he had said on old kinds of energy. So there are energy credits in his proposals.
So let me just kind of wrap up. And maybe I should have asked these questions before, but I'll open it up to all of them. And I like this one. Are wealthy Americans already prepping their finances for a Biden administration?
Well, I'm going to start by addressing that because I can tell you right out of my practice, because I do have a number of wealthy, and when I say wealthy, I mean married couples with net worth in excess of $25 million. And these are folks that are already, towards the end of 2020, they already have their estate attorney on speed dial. And the reason is that they are looking to those proposals that would ultimately reduce the estate exclusion amount. And that's not and was not necessarily very specific to President-elect Biden's proposals. We all know that that's a general democratically controlled kind of proposal to tax more estates. And so they're already looking at that in conjunction with the provision that came out of Tax Cuts and Jobs Act, IRS provision, that came out of the Tax Cuts and Jobs Act following this big increase in the estate exemption that said if you give away, if you use what is effectively your estate exclusion by gifting those amounts away during your lifetime, there'll be no clawback into your estate if you die with a smaller estate exclusion than the amount that you gave away in your lifetime, up to the gift tax exclusion amounts. And so they're already talking to their attorneys about that, about should I be making gifts? And the timing is sort of specific because under the assumption that there could very well be new tax legislation in 2021, historically when we've seen an estate tax change, whenever it occurs in the year, it seems to always be retroactive to the beginning of that year. So it's time sensitive in that regard about gifting. Now, that's just the one piece of it for wealthy clients because, Sharon, I think there are pieces of it about individual income tax as well.
Oh, I do. And so my wealthy client says, I'm going to have to change how I invest in real estate. I don't think he's worked out how to do it, but what I saw is instead of these quicker turnovers, these 2 or 3 year holding periods on some of his properties, he's talking about a 10-year holding period. He just switched from short-term mortgages to a 10-year mortgage. He said, I switched to a long-term mortgage. 10 years. I said, oh, okay. So his planning is stretching out because he's looking for the cycles now in who controls the White House and who controls Congress. So that was he did mention the estate tax. It's not that. But he's not willing to give away anything. I don't think he likes anybody to give it away to. I did suggest me.
I'm eligible for adoption.
Yes, me too.
Okay, one last question. Will high net worth audits increase?
Absolutely. I think
I don't want that as the answer.
Oh, yes. They've been declining. So these are for people over $1 million in income. And you can see the focus on President-elect Biden's programs are wealthy pay their fair share. And we have had a decline. I think it's a little over 6% of the people with more than $1 million of positive income are being audited now. That's about resources in the IRS. But I believe if he were picking the Secretary of Treasury, that he would start saying, I need more done and less done on the poor people for earned income credit and head of household and refundable child tax credit, and more focus on making sure that the wealthy know they have to pay their fair share. Now, what's fair or not depends on where you live. Since we live in a very high-cost area, our idea of middle-income people is different than what you might say in Montana or in some of the Midwestern cities particularly. So, yes, more audits.
And I agree that there would be more audits, but that is contingent upon not just the president demanding it of his Treasury Secretary, but also it is contingent upon Congress ponying up because IRS simply doesn't have the resources. So without budget appropriation, they won't be able to do that.
They need money. Their budget has shrunk so much in their people. Yes, Vern.
And I'm one of these few people that, being a CPA and a professional tax preparer, I don't mind audits. I mean, I don't like, you talked about the fair share. I don't like tax cheats. We work far too hard staying legit. Enough said of that one. I cannot thank both of you enough for joining in and giving us what do we kind of expect. And so this is Vern Hoven.
I'm Sharon Kreider.
And I'm Karen Brosi.
And the best of everything for you when we're doing these new programs.